Hi. So Corona came for your health, and the Corona impact came for your portfolio. Your portfolio is hurt and hurt very badly. And today, believe me, 23rd of March has been the worst day of the equity markets that I have seen. And believe me, I've seen over 40 years. 1979 I started, so you're talking about 40 years plus. What do you do in such a situation? You sure you look at your portfolio, you're not going to like it at all. Some shares have fallen by 20%, 25%. I mean, good quality dividend paying companies with 15-year track record have just been thrashed. Whoever thought that MNCs and well-run groups like Murugappa Group and all would see their shares decimated like this? But we all saw that, right? So really, what do you do? If you have a 20-year time frame, you may not have something to worry about, but it is difficult to sit calm in a market like this when everybody is losing their heads. So now you go back to what Napoleon said. You don't need to do anything extraordinary. Just hold your head when everybody else is losing their head. It is tough, there is no doubt. The leaders will change. The next set of leaders could be infrastructure, could be IT, could be pharma. And honestly, if you ask me, the only answer which I can give very confidently is I do not know. Is it a good time to put in all your money? I do not know. Is it a time to stop your SIP? I do not know. Is it a time to start a fresh investment? I do not know. But I can just tell you what I have been doing. I bought some shares on Friday and I thought, let me just try. And today I could sell them off in the morning because the morning the market was a little up. But as the day passed by, the market just kept crashing. And why did it crash? Is it just the fundamentals changed so dramatically? The answer is no, fundamentals didn't change. But what happens is many people trade in shares, they do futures and options, and when they buy shares with borrowed money. Take a simple example. I have got shares of, say, Cholamandalam, which was priced at 500 plus, which was priced at 300 plus. And I put 1 lakh shares, and which means about 3 crores of mine was lying with my banker or with my broker, and I could buy shares worth 1.5 crores because I had 3 crores lying there. Now suddenly the price crashed how much? It went from 3 crores to 1.5 crores in the same day. So how much did I lose? I lost 1.5 crores. That's not the problem. The problem is, based on that, I had bought shares worth 1.5 crores that had also fallen. So what does my broker do? He calls me up and says, hey, put in the margin, get me the check. I don't have the check because I bought something else with that. So he says, either you put in the margin or I sell off your Cholamandalam or I sell off your new shares which you bought, which could have been an Indian Oil, an NTPC, or Tata Motors, it doesn't matter. So he had to either sell my margin shares, which was Cholamandalam, or the shares which I bought. He chooses to sell Cholamandalam. So Cholamandalam, which had come down nicely to 153, gets sold because there are 10 other jokers like me who have put in that money and the share price goes to 135. What do? It's a good share, it is dividend paying, there is a good dividend yield, and so you just sit tight. Who got hurt the most? The people who had leverage buys. Leverage buy means people who had borrowed money to buy shares, they got hurt the most. People who had done FNO got hurt. People who had done naked shorts got hurt. People don't know why does the market fall so much. Well, there are 2-3 reasons why the Indian market fell. One, the FII sold. Why did the FII say this? Are they mad? Don't they know what's happening? Well, when you are an FII, largely you're managing other people's money. So somebody says, there is going to be a coronavirus and that's going to be bad for the world and India could be worse, so let me pull out all my money from emerging markets. This is called flight to safety. So money moves out of China, out of India, out of Japan. For them, this is Asia. Their crisis is not just in China, the crisis is in Asia. For them, they will know that whether India and China are far away, and for them what happens in China is going to happen in India tomorrow, so better sell. So they withdraw money from, say, an Asia fund or an India fund. If money gets pulled out of an Asia fund and India is overweight, obviously you lose money. And if money gets pulled out of an India fund, well, Indians obviously will lose money. The Tata Motors and the Reliance and HDFC and whatever they have, they are going to sell. They don't care because they're managing other people's money. They have no time to think. Second is the fact that all these trades are done by the machine. I remember in 2008 it was 1992, when this was the time when we were going into the ring. And so you went into the ring and you found that a share which was 600 rupees yesterday is now selling for 450. So you come out and tell the client, look boss, this has gone down from 600 to 450. Do you still want me to sell? He applies his mind and says, yeah, go and sell. I go in and find the price is 425. I still sell. But if this were a machine and said best order, so whatever price it is, it will sell. So if it is a 600 rupee share, which is in say F&O, which means there is no lower limit to how much it can fall in a day, well, you could sell it for 275, you can sell it for 375, you don't know. So these trades which have been triggered by the market and trades which have been triggered by the margin calls have to go down and have to go down pretty fast. So what happens? The fact that you lost money in 92, the fact that you lost money in 2008, the fact is you lost money in 2020. But in 92, the fall was much slower because you had to go into the ring, ask what is the price, come out, consult your customer and then go in. So you got some time. You also got a chance to apply your mind, and that was a time when people would hold 5,000-10,000 shares. Not this many shares were not held by one person. Institutional dealing was less, so there were individuals who were holding, and individuals could always be told, don't sell today, can you sell it later? Institutions don't listen. Institutions just say, we want out of India, and that's it. They press a button. I've seen that happening. I've seen that happening in 92. I've seen that happening in 93 when people would get out and they would sell 1 million shares of Reliance. For us, this was news. We never saw such a transaction happening. By the time we came to 2007, 2008, we had got used to FIIs. We got used to FII buying big quantity and FII selling big quantity. But this time, thanks to algo trading, thanks to margin trading, thanks to futures and options, thanks to mutual funds having redemption pressures, ETFs having redemption pressures, index funds selling, there was absolutely no place to hide. There was mayhem in the markets, everything came down, there was just no place to hide. So what is a good thing to buy now? I really don't know. The only honest answer that I can give for any question that you ask me today is, I do not know. Is it a good time to enter the market? I do not know. Is it a good time to put a lump sum? Say you got 1 crore of rupees or you got 10 lakhs of rupees. Is it a good time to put in? I don't know. You got your SIPs running. Should you keep it on? I think so, because I do think that the virus is going to have an impact, but we do not know what impact it will have. So the most important thing is any decision that you are making today is largely emotional. You're saying, oh, I don't think Castrol can go below 92. Well, tomorrow is another day. You don't know what is going to happen. Your HDFC Mutual Fund, your Cholamandalam, your Bajaj Twins, your HDFC Bank, those shares which were thought to be invincible have all gone down, right? Your shares which are MNC were thought they couldn't go down, they have gone down. So there could be some good companies, something in the infrastructure space, some welding electrodes, some grinding wheels. Those could do well, but will it go down? Well, you never know. ICICI Bank has come down. ICICI Prudential Life is now below the issue price. ICICI Securities is way below the OFS price. The OFS price was 520. It is now below 260, which is the halfway mark. In fact, it is at 225. Can it go below 200? I have no clue. And I have no reason to say it can't go. Same thing for Nippon Asset Management, HDFC Mutual Fund. They've also crashed. Okay, you could always argue that the AMCs will suffer because the AUM will go down. But a share which you thought was a good buy at 452 is now not buying any takers at 226, which is half the price from its peak. And believe me, Nippon doesn't have too much of floating stock. There's only 5% floating stock. So why does it crash so badly? Simply because there's no buying support. Simply because somebody could have given the Nippon shares as a security to buy shares of something else, and that may have fallen even more. So if the shares which you have bought have fallen, which means you are making notional loss, your broker is not going to wait for you to pay up the margin. He's going to say, hey, what other shares do you have? You have Nippon, sell it off. Because that is what I know can be sold in the market. I can sell 10,000 shares of Nippon, but with some share which you are just unable to do that kind of volumes. So what do? Who's selling? Not the person holding the shares, but the person who has lent money. He's got to protect his money, right? So he is selling the Nippon share. So if Nippon has been given by somebody as a collateral, well, it's getting sold. If somebody had given Z as a collateral, that's getting sold. If somebody had given Colgate as a collateral, that's getting sold. If somebody had given Gillette as a collateral, that's getting sold. What's happening in ITC? The ETF is ensuring that constant supply of ITC shares are available, and therefore I think ITC will struggle going up. There is just too much supply, and that is exactly the reason why Hindustan Unilever is not going down, because it is in the index. If about say 40,000 crores to 50,000 crores gets invested in the index regularly on an annual basis, 5% of that, which is about 2,000-3,000 crores, goes into HUL. HUL has no supplies coming. Nobody sells HUL. Anybody who has HUL just holds on and hopes for dividend improvement. They don't sell. So A, there is no floating stock available. B, there is huge demand thanks to the index and thanks to the fact that many companies would prefer overweighting HUL even in the index. So there is demand on one side and no supply on the other side, which means Hindustan Unilever can't go down. Having said that, in a market like this, everything goes down, right? But HUL is likely to come back much faster than say ITC. You need to understand all these nuances if you want to invest directly into equity. If you don't want, you can always go to a mutual fund. First find an advisor. Especially in difficult times, find an advisor, meet 2, 3, 4 of them, get good references, then decide with whom you want to invest your money over a long period of time. If you have 30 years of age, imagine next 40 years you need to deal with them, or maybe next 50 years you need to deal with them. Be very careful. There are a lot of good advisors. Check their qualification, check their references, talk to them, see whether you are comfortable. If you're comfortable, go with them. Lots of them around. If you are not comfortable, stick to something like an index fund where there is no brain required. The fund manager does the work and it's an index fund. You don't have to do too much. Then keep learning. Get an IFA, which is an advisor, independent financial advisor. Ask him what to do. Keep learning, and once you are happy with what you have learned, then start investing. Till then, index fund is good for you. Thank you.